Trading is not as difficult as you think it is. And in this video, I'm going to explain why. In simple terms, to make money trading, if we focus just purely on win rate, if you have a 55% win rate at 1-to-1 risk reward, that means for every 1% you risk, you make 1% and you win 55% of your trades, you are a profitable trader by definition. And what you'll find is there's loads of fake gurus out there, especially on X. There's TikTok traders with Discord groups, Instagram traders, whatever, that aren't profitable. They're just selling courses, coaching, whatever. But what you'll find is that those traders, if they're not profitable, surely there is a logic in reverse trading them.
Four, three, two, one, boom. Bye bye, tata, goodbye.
For example, if they have under a 50% win rate, a 1-to-1 risk reward, if you just did the opposite of them, you would have a winning system, right? And if you build enough data, even on an unprofitable trader's track record, I guarantee you can figure out a profitable system. What people aren't doing is they're not building the data. And by not having the data, they're not consistent. They don't understand their edge. They don't understand how to make money. Now, there are a couple things with this, but I want to take you through how I build my trade plan, because my trade plan all comes down to data, and how I refine it, how I change my trade plan as I progress through my trading career, all comes down to what the data feeds back and what it tells me. So the key things to identify in your trade plan, for example, are your assets. Now, I'm going to talk a little bit more about cross-asset alignment in this video. I'll go through that later. But the main thing you want to understand is if you focus on less assets initially, so I get my new traders to focus on euro dollar, pound dollar, Aussie dollar and New Zealand dollar, US dollar, and they can also look at the Dixie with that. But if you just focus on two even, euro US dollar and pound US dollar, and throw in the Dixie for alignment, or US 500, US 100, US 30, using those three because they move in unison, and understanding how each pair moves is where we can utilize cross-asset alignment. I have this table here that shows you how each individual pair moves with other pairs in the FX market, with the S&P, etc. But it's not necessarily as simple as that, because sometimes Dixie can be going up on a tariff announcement, which has a positive correlation with the S&P 500. Well, in this table, the Dixie has a strong negative. That's in a risk scenario. So if there's risk off, money's going back into Dixie, back into dollars, it's coming out of the S&P 500, so they're going to move inversely. So the key is actually understanding what market environment you're in. But screenshot that, use it if you need to. Also download my PDF under this video where I go through cross-asset alignment again. It's really important, but understanding the market environment comes before all of that stuff. If you don't understand what environment you're in, this table really means nothing. And that's why my edge, although mechanical, has a discretionary element to it. And it's about understanding market environments and then utilizing cross-asset alignment. Now, my system is 100% technical. Other than that element of discretion, the reason for why I take my trades, my entry criteria, is 100% technical. For me, it's just a tick box process. Try and make your system, the technical side of your system, as mechanical as possible. If it's confusing and you have 100 different criteria that you're not sure what goes with what, then it's too complicated. You need to be able to summarize your system in 2 sentences at most, right? Once you have your tick box process, the only thing really to do is execute the trade with the trade parameters. Now, the trade parameters are all defined again by your data. Once you're in the trade, you have live trade management. Do you move stops to break even? Again, defined by your data. What's it best to do? You have to have a big sample size, minimum 150 trades. 1,000 trades even better. The more trades you have, the more accurate the data is going to be, right? And the more meaningful, the more significant it is. But your entry criteria needs rules. So the tick box process is also rules. That becomes part of your trade management too. They are rules. They're not based on how you think or how you feel about the trade. It's purely just a mechanical rule-based process. And you're always going to have do's and don'ts in there. They will be defined by things that you recognize that you do psychologically, which you shouldn't be doing, and so on. Aside from that, you need a routine. What time of day are you going to trade? Are you just trading US 500 and US 100, so NASDAQ, the S&P at New York Open? If so, define it. That's absolutely fine. but you need to define everything around that routine, not just what you do when you're looking at the markets. I trade from 2:30 UK time or 8:30 a.m. New York time or whatever. You need to actually define your day. What do I do when I wake up? Do I have a prep? Do I have a pre-market ritual? Do I meditate, get my mind clear? Do I make sure I'm fasted? Do I perform better when I eat? You know, I've talked about this in other videos. You're an athlete. You need to be focused. You need to be ready for your session, whatever that might be. What's your post-market ritual? Do you have a review, journaling process? Do you review your psychology? All this stuff. In my trade plan, I have the times I should be going to bed, the times I need to wake up, the time I need to eat my first meal. All that stuff comes down to good structure, good routine, because I'm operating at a high level as a trader and I need to make sure I maintain that. We've gone through what assets you trade. We've gone through cross-asset alignment. But this again comes down to data. Find where your edge lies. Start really simply. Euro dollar, pound dollar, Dixie. Talked about it already. Or if you want to trade the indices, start with US 500, US 30, US 100. If you're a futures trader, trade the equivalent futures contracts. If you're trading CFDs, trade the CFDs. But wherever your edge lies, you need to focus on building the data there. And if you haven't found your edge, narrow it right down to a couple of pairs, a couple of assets, a couple of instruments, and focus on them only. Gold is another one, popular instrument. People love to trade. Trade it with silver. Trade gold and silver. Platinum if you wish as well. Or trade gold, silver, and use the Dixie for alignment again. Making sure you understand that there's no point picking Euro, US dollar, and UK oil, for example. That doesn't make sense to trade those two. It makes sense to utilize pairs that move in unison with cross-asset alignment using this table. Then the biggest and most important part for me, journaling. So journaling is so important. It has built my edge. I wouldn't have an edge without journaling, right? And that data collection process is the most important part of my trading. I've shown my journal in multiple other videos. I'll show you again here. My current journal at the moment, building my new journal for 2026. Current journal for this quarter at the moment shows my win rate with various different parameters. I trade only with cross-asset alignment. So I have built data at around a 70% win rate on different trades. But if I filter this column out to only be trading with cross-asset alignment, then I know my win rate is at its peak at the moment of 82.6%. I haven't logged any trades in here this week yet either, so that actually needs to change. But that is how I collect my data, and that tells me everything I need to know. And actually moving into 2026, I'm already building the template for my new journal because there are things I've been noting all year that I want to track. My drawdown as a percentage of ATR is one of those things. So I want to see what my drawdown is as a percentage of ATR rather than a pip value, because that then becomes more relevant to track across different markets. You know, for example, crypto, gold, whatever. ATR at time of entry. So I've really been focusing on the volatility. Are we moving a lot? Are we excessively driving outside the average true range on the day? The alignment asset. So am I finding that my alignment is more consistent using certain assets? For example, the Dixie. If I use the Dixie in alignment with my trades, am I more consistent there? Or do I need to make sure that I have alignment on 3 assets, for example? I might find at the end of Q1 next year, all my trades with 3 or more alignment assets were the most profitable. When I went down to just 1 or 2, maybe it was less. You know, these are the things that I need to track. Market conditions, hugely important. And these are all pre-filled. So I just select what they are when I select the trade. Now, market conditions, again, I know that I trade best in a range. So I want to identify exactly what determines a range. Do I determine a range by going on the charts and simply looking at the last couple of days of 4-hour candles or 3-4 days of 4-hour candles? Or do I look at the 1 hour? You know, these are all things that I can quantify. If we look at the 1 hour here, from the 7th of November to the 11th, there was a clear range there. So what sort of time frame do I measure that by? Do I measure it by a fib? Do I measure, for example, on the daily, the top and bottom of the market, and then assess whether I am around or in between the 38 and 61? If so, maybe I'm in a range. Do I measure it by breaking structure? For example, we broke the last leg here, so now we're in a downtrend. Therefore, is this considered a range? It's all about looking at a certain number of candles and understanding where my range is within the market. So another thing that I'm looking at there. But that data collection process, that is the most important part of my trading. And that follows on with the data review process. So the data review obviously being hugely important, because reviewing that data is where I quantify things and where I figure out what's working, what's not. Let's do more of what is, less of what isn't. Then for me, when to implement changes. Now for me, this is quarterly. I will look at implementing changes at the end of every quarter. Unless a quarter is very slow, for example, Q3 of this year didn't build enough data, didn't give me enough to make changes, so I'm just going to push it to the end of Q4. And then that goes all the way back to the trade plan. Do I need to change these things again? Because when to implement the changes, do I need to change this, the entry criteria, the trade parameters? Do I need to change the assets, the time of day? Am I not profitable anymore in London session, but only New York? You know, there are all these factors that I need to consider. Even in terms of my routine, you know, is that something that's coming across in my data as well? And then the most important thing, aside from the data, is the goal. Now, obviously, there are two ways you can go with trading, and I've talked about this in another video, but one of them is that you could be pushing towards prop firm funding. The other is that you want to build a fund. You want to have a family office one day. You want to manage your own capital and build to 7 figures. You know, the goal determines exactly how you do this, in my opinion. Now, win rate and risk reward being hugely important, because, as I've said, a higher win rate is much more suited to a prop firm evaluation, because you have tight drawdown parameters. You can't lose too much money. But maybe a higher risk reward is more profitable over 1,000 trades, over 100 trades. And that would be well suited to managing your own capital or managing a fund. Sure, a higher risk reward is also suitable to prop firms, but there is a way that I would suggest trading them to maximize on that. And that's something that I teach with my students. Now, if we look at this table here, you can understand what your consecutive losses are in terms of win rate. So let's say, for example, you found a trader on X who claims they're really good, and they've got 1,000 people in their mentorship. You've worked out, you've done the maths, and you've recognized they're making 58K a month from mentorship, so they probably don't even trade. And you recognize that their system is actually not profitable. You've collected 100 trades worth of data on their system. And you might think this is not time well spent. It is time well spent. You can develop a strategy from this losing trader. And what you see is that they always go for 1 to 5 risk reward. And they tell everyone they've got a 35% win rate, a 1 to 5 risk reward. Great. That's a phenomenal system. That would make money. That's what they tell people. But what you've decided to do is you've decided to take every single one of their trades at 1 to 1. And their stop loss is always your stop loss, and the 1 to 1 TP equivalent is your take profit. Now they're going for 1 to 5 every time, but you're just going for 1 to 1. You can see if that system is profitable. You do 100 trades with them, 150 trades ideally, and you see that actually at 1 to 1, they've got still a 35% win rate. They claim they had it at 1 to 5, but you've just found they've got it at 1 to 1. What does that mean? That means that you've just found a system with a 65% win rate at 1 to 1. And actually, if you measure all the metrics within their system and you look at, does it ever do 1 to 2? Does it ever do 1 to 3? 1 to 1.5? All those things, measure it. How many pips drawdown on average do their trades do? Do you need to change the parameters? If you reverse trade them for the next 150 trades at 1 to 1, then essentially you should have a winning system, or 150 trades. Again, ideally, more trades, the more trades, the better. So if you find one of these ex-traders or TikTok traders that's taking like 3 to 5 trades a day, great, because that's going to give you loads of data really quick. You'll get it done in a month. But this then can be where you build your system. And I'm not saying you have to do that. You don't have to find an ex-mentor or a TikTok mentor, a fake guru, whatever, that's going to not be profitable. You don't have to do that. I'm not going to emphasize that. The reason I'm talking about it in this video is because I want you to realize that you don't even need to find a profitable system to be profitable. Worst thing you could find is a 50% win rate at 1-to-1, because you can't even reverse that. Either way around, it's not profitable. But if you build 150 trades, 50% win rate at 1-to-1, I guarantee there is something within your data that will allow you to tweak that system and make it profitable. For example, time of day. For example, working out what your max drawdown was or your average drawdown was. Could you trim the stop loss? What was your missed potential per trade? Tweaking those basic parameters on your trades will tell you exactly how to be profitable. And the reason this is hard to sell for me as a mentor is because most people don't want to put that work in. They want to get rich tomorrow, and they're in, we're in the TikTok generation. It's instant gratification. Putting in the work to understand your data, building journals over hundreds of trades, and this is obviously just since September. I have thousands of trades in Google Sheets. But doing all that work is not fun. People don't enjoy it. I mean, I enjoy it. And actually, the students that I have do enjoy it because they are serious professional students. They're in this for the long game. Some of them are even professional clients with various brokers. But you have to understand your metrics. You have to understand your data. You have to understand your system. And this is where we come into the consecutive losses phase. So if your goal is prop firm related, you should be trying to push this number as high as possible, whilst meaning that your consecutive losses are lower, because you have drawdown limits. And those drawdown limits are going to stop you from potentially becoming profitable in the short term, because you might hit, for example, you could be a very profitable trader. You could have a 50% win rate at 1-to-2. That's a phenomenal system. It's going to make a huge amount of money. But if you trade at 2% risk per trade, you've got a 97.3% chance of hitting 4 losses over 100 trades. Now, 4 losses at 2% risk a trade is 8%. Well, some of the prop firms have an 8% drawdown limit, some even less, some of the futures firms even less. So that means you're going to blow the account. But that doesn't make sense, because you're a profitable trader with a system that has a 50% win rate at 1-to-2, but you blew the account. This is why prop firms and passing evaluations don't necessarily mean you're a good trader. Even getting payouts, they don't mean you're a good trader. Let's take the flip side of that and the optimal way to trade prop firms. Well, if you have an 80% win rate, or let's say 75 would be more conservative, and you risk 2% per trade, you now have a 25% chance of hitting 4 losses in a row. That is drastically different to a 97.3% chance. So your chance now of passing a prop firm, getting payouts, etc., is massively in your favor. And actually, 5 losses in a row, 6.8%. Whereas with a 50% win rate at 1-to-2, 81%. Now those systems will generate the same amount of money, a 75% win rate at 1-to-1 or a 50% win rate at 1-to-2. That will generate the same return. Statistically, basic maths. But one has a 6.8% chance of 5 losses and the other one has an 81% chance. This is why for me, win rate is hugely important. It's more important than risk reward for me, especially trading for retail prop firms. Now, if we look on the charts, you'll see that if I go on my euro dollar chart here, in fact, if I do this one, pound dollar, you'll see that I have my stop loss take profit 1-to-1 indicator built here in the bottom right hand corner. This isn't just plucked out of thin air. These numbers here are again all based on my data. So if we go back to this, you'll see that I get to this point at the end of the quarter. I've figured out what my optimal parameters are. They then go back into my trade plan, and then here we go, 100% technical. My entry criteria is defined, and then my trade parameters are adjusted based on the changes that I need to implement in my data. People massively overcomplicate this whole process. The reality is, if you just find a system with a 1-to-1 risk reward, work out whether it's profitable or not. If it's profitable, optimize. If it's not profitable, reverse trade it and optimize. Then you should be a profitable trader long term. The key is understanding that the more data, the better. And also the market is cyclical. There are market phases and they change. So you want to try and stress test your system through every phase of the market. For example, through tariff announcements, does your system perform, or do you need to then take a step away? You'll only know that through experience and through data collection. Or does your system work well on NFP Fridays, or is that a day to stop trading? All these factors come into play, and they only come into play through your data collection.